Gold just shattered $4,580 an ounce. Brent crude is trading north of 113 bucks, and headline inflation, it just spiked to 3.8%. Right now, the Federal Reserve is completely cornered by a historic geopolitical crisis. And honestly, the mainstream is largely ignoring just how severe this macro shock really is. But today, we're going to break down the exact data driving all this chaos, look at how the new Fed chair is literally ripping up the old playbook, and crucially, we'll go over the exact specialized strategy you need to defend your portfolio right now.
So let's look at April 2026. Headline inflation hit an agonizing 3.8%. That is a painful three-year high, and it pushes the Fed's 2% target line completely out of reach. Now, this sudden spike, it isn't an accident, and it's definitely not random. It's the direct result of surging energy costs that are actively bleeding into housing, utilities, and transportation. We are dealing with a severe supply-side shock here. It's rapidly eating away at consumer purchasing power and, frankly, forcing the entire market to completely reprice risk.
And the root of this shock is undeniable: $113. That is the price of a single barrel of Brent crude right now, with West Texas Intermediate trailing just behind at 105. This isn't just some number flashing on a ticker. This is a catastrophic energy tax on global growth. It dictates everything, from maritime shipping freight costs all the way down to domestic manufacturing. When oil breaks 100 bucks and actually stays there, it drags down global GDP and pushes inflation higher at the exact same time. But to understand why oil is sitting at $113, we really have to look at the geopolitical map. The situation over there deteriorated with terrifying speed. In late February 2026, international negotiations completely broke down. By March, a U.S. naval blockade was initiated right across the Strait of Hormuz. And by April, a staggering 2 million barrels per day of crude were completely halted. Just to put that into perspective, the Strait of Hormuz is a critical choke point that handles roughly 30% of the world's seaborne petroleum trade. When you sever a third of global supply overnight in an active conflict zone, the economic shockwaves are immediate, they are severe, and they are incredibly difficult to reverse. Now, before we look at how the Federal Reserve is handling this unprecedented crisis, I do need to pause for just a moment to remind you that all investments involve substantial risk, illiquidity, and potential loss of capital. Past performance does not guarantee future results. Securities offered on various platforms, including investments in real estate, are highly speculative. You should not invest unless you can sustain the loss of a total loss of capital. Always consult a financial advisor or a tax professional to assess the risks associated with investing in privately offered securities. Section 1. Warsh's new Fed Playbook. Rates are held at 3.75%. So how does the central bank actually respond to an active stagflationary test like this? Well, Kevin Warsh, the newly confirmed chair of the Federal Reserve, is flat out refusing to hike aggressively into a supply shock, but he's also absolutely refusing to cut. He's effectively throwing out the old central